Mortgage rates finally moved in the right direction this week. And no, it was not because the Fed cut rates. Rather, it was on the back of Jerome Powell's comments. Go figure. If you want to understand what that impact had to the market and where we see the market going from here, stay with me. So again, as I mentioned and as I opened, yes, we know the Fed cut rates this week as expected. Absolutely no surprise there. Walking into this week, the markets were betting on a 0.25% rate reduction, and yes, we got it. No impact really prior to the press release, and on the back of that update, markets were flat. There was absolutely no movement. It was par of the course. And then our good old boy Jerome Powell took the podium, and that's where we saw really the I wouldn't call it an explosive rally, but a very, very solid rally where mortgage rates improved in lockstep with his communication. And it was centered around three very key points. One, he acknowledged that the labor market may be not as strong as once perceived. And a lot of the initial jobless claims that were seen post shutdown may potentially be overstated. So it's caused an area of pause for the Fed in that, hey, we feel the labor market might be not super strong. Second, he also, for the first time through this entire cycle, indicated that tariffs might actually be working in the inflation front, in that we are starting to see inflation coming down. Yes, I know we're still feeling it at the pump in the grocery markets, but the market picked up on that in a very dovish tone, that we're starting to see hey, inflation might be working itself out. Maybe we don't need to hang out at these levels, which he directly indicated that rates being where they are, even with the reduced amount, is still on the higher end of their neutral stance. So markets picked up on that very quickly, and in turn, mortgage pricing improved almost immediately. Followed by the last component that was brought up was around the Federal Reserve is now going to be purchasing treasuries. And not to bore you with the details, as I've mentioned before, the Fed has effectively were in a quantitative tightening stance, meaning they weren't investing money into the money markets. That stopped December 1st. Pretty much took a pause, weren't doing anything, and allowing mature or items that were maturing on their balance sheet to run off. Well, now that has stopped, and they're now repurchasing treasury, which in an effort to stabilize liquidity in the market. Why that's good is liquidity in markets creates an element of stability. So as we've seen over the last 3 years, these violent whipsaws in mortgage pricing. One day we're great, next day, oh my gosh, the world's on fire, followed by, yes, we're back to great. We should start to see that cool, which in turn presents massive opportunities for our clients taking action now in the holiday season and as we approach the spring market. This continues, these opportunities shift and shift quickly. If you would like to coordinate opportunities and communicate these opportunities to your client, please reach out, as these things move on a dime. We are here and happy to communicate and help. As always, let's make it a fantastic Friday and an even greater weekend. Thanks again.